Hey, so the government is shut down, yet the stock market just hit a new all-time high. This makes absolutely no sense. Or does it? Chasing this rally right now could be the most expensive mistake you make all year. Look, if you're busy, here's the one thing you need to know. The big money isn't chasing these highs. They're waiting. And I'm going to show you the exact price levels they're watching to buy the dip. And more importantly, why this seemingly bizarre market behavior actually follows a very predictable pattern. For those of you who are new here, my name is DataCat. Let's just say I spent enough years staring at spreadsheets inside a Fortune 50 company to count all 9 of my lives. I'm not a Wall Street guru or some kind of trading wizard. I'm just an average analyst who traded in a cubicle for, this. My goal here is simple, to look at the raw data, the numbers on the tape, and figure out what's really going on without all the hype. Because honestly, the market can be like a cat. One minute it's purring on your lap, the next it's clawing your portfolio to shreds for no apparent reason. My job is to spot when it's about to get feisty. So let's get into this. The government shuts its doors on day 1, and the market goes up. The S&P 500 closed up 0.34%. The Nasdaq did even better, both hitting fresh records. On the surface that feels very counterintuitive, right? But here's what most people don't understand about government shutdowns and markets. This isn't the first rodeo. In fact, Wall Street has a pretty detailed playbook for exactly this scenario. First, let me walk you through what actually happens during a government shutdown, because the mechanics matter here. When the government shuts down or fails to pass a continuing resolution, what happens next is that all non-essential government services stop. We're talking about roughly 750,000 federal workers getting furloughed, according to the Congressional Budget Office. National parks close. Certain regulatory agencies stop processing applications. And more importantly, for us as investors, economic data releases get delayed or cancelled entirely. The Department of Labor already announced that virtually all of its activity will cease. That means the big jobs report, the non-farm payrolls number that was scheduled for Friday, won't come out if the shutdown continues. Same risk for CPI, PPI, retail sales data, JOLTS, or even GDP releases could be at risk if this drags on. So the market is essentially flying blind. And you'd think that would freak investors out, right? Uncertainty is supposed to be bad for stocks. But here's the thing. Wall Street has seen this movie before, and they've crunched the numbers on what actually happens. Bank of America went back and looked at the historical scorecard across multiple government shutdowns. On average, the S&P 500 was roughly flat during shutdown periods. Not down, flat. The VIX also stayed about flat. But here's what did move consistently. The US dollar weakened by about 1%, and 10-year Treasury yields dropped by about 4 basis points. Goldman Sachs has a similar model. They estimate that each week of a shutdown shaves about 0.15 percentage points off GDP growth. So if it lasts 2 weeks, that's about a 0.3 percentage point drag. And this is crucial, that economic activity isn't destroyed, it's delayed. Once the government reopens, you get a mirror rebound. The spending and activity that was postponed comes rushing back. So historically, these shutdowns have been temporary, modest economic speed bumps with no lasting market damage. Now, the market isn't stupid. Investors are looking at prediction markets, places like Polymarket, where people are literally betting on how long this will last. Right now, those markets are pricing in roughly 2 weeks. The consensus is that this gets resolved by mid-October. So that's the first reason the market went up. It's treating this as a known, manageable, short-term event. But the second reason is where it gets really interesting, and this is the part that separates retail investors from the professionals. On the same day as the shutdown, we got the ADP private payrolls report. ADP is a private company that processes payroll for a huge chunk of American businesses, so they have real-time data on hiring, and their report showed that private payrolls fell by 32,000 jobs in September. Coincidentally, that's the biggest drop since March of 2023. Now, if you're thinking about the economy, that's actually terrible news for common folks like you and I. Job losses mean less consumer spending, slower growth, potential recession risk. But if you're thinking about the Federal Reserve, that's actually good news for the market. Allow me to do a quick recap here, because this is one of those things that feels backwards until you understand the game. For the past couple of years, inflation has been the bigger worry, so the Fed raised interest rates aggressively to cool things down. Higher rates make borrowing more expensive, which slows business investment and consumer spending, which eventually brings inflation down. But now we're seeing signs that the labor market is softening. The ADP report is one data point, and because of the shutdown we won't get the official government jobs report to confirm or deny it. The Fed is going into its late October meeting with less information than usual. And when the labor market weakens, the Fed's calculus shifts. They start worrying less about inflation and more about recession risk, which means they're more likely to cut interest rates to support the economy, supporting the more cuts narrative the market has been expecting. So we have this weird dynamic again, where bad economic news is good for the market because it increases the odds of Fed support. Treasury yields fell after that ADP report, the dollar weakened, and stocks went up. The market is essentially saying, yeah, the economy might be slowing, but the Fed's got our back. And just to complete the cross-asset picture, gold, the classic safe haven asset, hit new all-time highs. When there's policy uncertainty, when there's a data blackout, when the dollar is weakening, investors pile into gold. So you had this simultaneous move. Stocks up, bonds up, meaning yields down, dollar down, gold up. That's the signature of a risk-on with a hedge environment. But that's just the story, the narrative. As an analyst, I don't trust narratives. To be honest, we often control the narrative by manipulating the numbers behind. So let's pull up the chart for the SPY and see what the tape is actually telling us. Alright, first thing, the primary trend is without a doubt bullish. The model I use gives it a trend strength score of 100 out of 100. The price is above the 20-day exponential moving average by 1.58%. It's above the 50-day SMA by over 3%. And it's above the 200-day SMA by nearly 12%. We also have a golden cross in place for 66 days now. It's a long-term bullish signal. The ADX, which measures trend strength, is sitting at about 27.5. Anything above 25 means you have a real trend in place, not just noise. So this is a strong cat, no question. But, yeah, I know there's always a but. The momentum is slowing down. Let me show you what I mean. The RSI right now is at 69. That's still strong, but it peaked at around 75 back on September 22nd. So we've been cooling off for about a week and a half. The MFI has dropped from about 85 down to 63.5. That's a pretty significant decline. While it's not screaming distribution or selling pressure, it's definitely showing that the buying enthusiasm has cooled off a bit. Meanwhile, the stochastic oscillator is also deep in the overbought zone. Now in strong uptrends, the stochastic can stay embedded up there for a while, but it does flag that we're stretched. And here's another key metric, the rate of change. Over the past 10 days, SPY is up 1.69%. Over 30 days, it's up about 5%. Over 60 days, it's up about 8%. Notice the pattern? The shorter the time frame, the slower the gains. That's deceleration. The rally is still intact, but it's losing some steam. This is like a cat after a big sprint across the living room. It's still standing, but it's breathing heavy and thinking about a nap. Well, it's not a signal to sell everything, but it's a clear signal not to chase it. And the volume confirms this. The breakout to this new high happened on volume that was about 95% of the 20-day average. In other words, slightly below average. Now, in technical analysis, volume is confirmation. A real powerful breakout should have a surge of volume behind it, ideally 1.2 times average or more. This was more of a quiet creep higher, like a cat trying to sneak up on something rather than a confident pounce. Let me also talk about the price structure itself, because this matters for understanding where the market might go next. SPY closed at $668.45, just a hair below the new 52-week high. It was clearly a breakout day. But there's a rule of thumb in technical analysis. You want to see the price hold at least 1% above the breakout level to confirm it's real and not a false breakout. We haven't achieved that buffer yet. The candlestick pattern on the day was with a strong green body and a small upper wick. That means the market opened higher, dipped a bit during the session, but buyers controlled the close. That's mildly bullish, but not a home run. So, let's talk about support levels, because this is where the rubber meets the road. If you're looking to add to positions or enter new ones, you don't want to buy at the highs. You want to buy at logical support zones where the risk-reward is in your favor. The first level of support is very near term, at $662.17. That's the most recent minor consolidation area. If we dip below that on a closing basis, it's the first yellow flag. The next level, and this is much more important, is the 20-day exponential moving average at about $658.06. The 20 EMA is a dynamic support level that tends to act as a magnet in uptrends. In fact, over the past 20 days, all the closes are above the 20 EMA. It's the first line of defense for this uptrend, and it's the first logical spot for dip buyers to show up. If that doesn't hold, the next zone is between $654.40 and $650.30. This area is what we call a confluence zone. It's where multiple technical factors line up. When price hits these levels, it often bounces, signaling a high probability spot for buyers to step in with more conviction. And the max pain level, the spot where a pullback would really sting but would represent a very high quality buying opportunity, is down around $645. That's the 50-day SMA. The price is currently around 3% above it. A test of that level would shake out a lot of weak hands. It would reset the momentum indicators, and it would be a prime area to look for a reversal. Historically, the 50-day has been a rock-solid support in this bull market. Below that, you're looking at $640, which is a deeper Fibonacci level and a prior consolidation zone. If we actually get down there, the whole thesis needs to be re-evaluated. So, to put it all together, the market is strong, but it's tired. The government shutdown is creating this weird situation where bad news for the economy is good for stocks because of the Fed. The data blackout means we're flying blind for the next couple of weeks, and the technical picture shows a low volume breakout with decelerating momentum near all-time highs. But there's a bull case, maybe 30% probability, where the shutdown gets resolved quickly, the Fed comes out with dovish, meaning easy money rhetoric, and we get a durable break above 669 with strong volume. In that scenario, the next upside target is the trend channel zone between $679 and $685. On the other hand, the tech sector would likely outperform in that scenario because lower rates benefit high-growth names. Then there's a bear case, maybe at most 15% probability, where the shutdown drags on longer than expected, the data blackout creates real uncertainty, and we lose support at $654. In that case, we're likely headed down to test $640, and you'd want to cut risk or hedge. And as always, the smart play here isn't to chase the rally, it's to be patient. To act like a cat waiting for the perfect moment to pounce, react, not predict. Now, what should you be watching over the next couple of weeks to know which scenario is playing out? First, watch the shutdown headlines. Any signs of a bipartisan deal? Any Senate or House vote schedules? Any updates from those prediction markets? The longer this drags on, the higher the downside risk for equities. Second, watch the private data proxies. Since the government data is offline, things like ADP, the PMI surveys from ISM, and any other private sector reports are going to carry extra weight. If those continue to show weakness, it reinforces the Fed easing narrative. Third, watch the Federal Reserve. The October FOMC meeting is coming up. Any speeches from Fed officials, any hints, any discussion of how they're handling the data blackout, that's all going to move markets. Fourth, watch the cross-asset signals. If Treasury yields keep falling, that's supportive for growth stocks. If the dollar keeps weakening, that's generally good for equities and commodities. If gold keeps rallying, that's a sign that uncertainty is still elevated. And if credit spreads start widening or the VIX starts spiking, that's your red flag that risk appetite is deteriorating. And fifth, earnings season is about to kick off in mid-October. The banks report first. Listen to what they say about loan demand, credit quality, and any exposure to federal spending or approvals. Sectors that rely on FDA approvals or companies in the IPO and M&A pipeline which need regulatory sign-offs may discuss delays. Look, I'm still pretty new to this whole YouTube thing. This channel is only about 2 months old. If you found this breakdown useful and you appreciate a no-hype, data-driven look at the markets, consider subscribing. I put out videos breaking down what the numbers are telling us, not what the headlines are shouting. And if you have questions, or if there's a specific stock or sector you want me to analyze, drop a comment. I read them. I'm just one guy, one cat, trying to make sense of the markets without all the noise. That's all for me. Stay disciplined, watch your levels, and don't let the market treat your portfolio like its personal scratching post. Alright, DataCat out. Stay safe and stay sharp out